Hey, good day, everyone. Welcome to the Bert Salazar Retirement Show. I'm excited to be here with you today, as I am every single week. I'm going to be doing a short webinar for you, but it's going to be very, very important because it's going to deal with the changes to Social Security benefits in 2023. Along the way, I'm also going to share with you some tax planning techniques that most of you, if not all of you, should be aware of. So this is going to be a PowerPoint presentation, and I am going to go ahead and turn on my presentation at this time. But, I want to welcome you all. I mean, it's winter time now. We're fast approaching the end of 2022. So I'm hoping that all of you are having a great Christmas and that you're going to have a great new year, and that 2023 is going to be much better. It's going to be much better for you and your family than 2022 has been. So I'm excited about a new year. Every new year brings new beginnings and changes that you're going to do in your personal life, in your family life, in your business life. So it's always important to take that little break and start working on the things that are going to be the most critical for you, your family, and your business in 2023. So let me go ahead and share my screen so all of you can see it. And let's go ahead and get started on the 2023 Social Security benefit increases and some of the critical areas that I think are going to be very important for all of you to pay attention to as we move forward into 2023 and beyond. So what are some of the benefits that we're going to be seeing in 2023 when it comes to Social Security benefits? Well, one of the nicer ones, but it may not be necessarily nice in the sense that your Social Security benefits are going to be increasing to the level of an additional 8.7%. Now, that's a pretty big number. I think we've only had over 8%, maybe once or twice in the history of Social Security benefits. And the reason why those benefit increases are at the level of 8.7% is that inflation has been extremely high for the last 12 months. So Social Security Administration every year takes a look at the average inflation rate, and then depending on where inflation is, then they go ahead and give you a bump up on your Social Security benefits. Usually it's anywhere between 1.5 to 2.5, sometimes 3%, but 8.7%, it's a big number. Now, although you may see it as a big number, there are going to be some challenges along those lines. Number one, right now, based on the last numbers that I saw for last month, inflation is hovering close to 8%. But when it comes to the essential goods and services that we all have to purchase on a daily and or weekly basis, inflation is closer to anywhere between 13.5 to 15%. So just be aware of that. But it's nice to at least get an 8.7% inflation increase on your Social Security benefits. Now, Medicare premiums, on the other hand, they're going to be receiving a reduced decrease. So I think in my case, I already ran the numbers. It's going to be somewhere about $6, maybe a little bit over $6 per month less that I'm going to be paying in 2023 versus what I have been paying in 2022. Now, one of the major challenges that you're going to find with an increase in Social Security benefits is that although the benefit increase may be a good thing for you and your family, you're also going to be susceptible to pay a higher tax. And the reason for that is that, provisional income thresholds are not indexed for inflation. So provisional income calculations will determine, and we'll go into some detail on that, what percentage of your Social Security benefits are going to be taxed in 2023. And obviously, the higher the Social Security benefit that you receive, the higher the propensity to have an increase in your tax liability for that given year as well. Now, and this is sad because most Americans are going to pay taxes on their Social Security benefits. Now, you can either pay at the 50% rate or the 85% rate. And your taxes may increase in 2023 due to these same provisional income calculations that I will share with you this afternoon. So it's important to keep an eye on that. It's very, very important for you to be able to do some tax planning, because if you don't plan for your taxes, the government will. And that's not the type of plan that I want to be in, either for myself, my family, and or my business along those lines. Because, sadly, most Americans are clueless when it comes to tax planning. And this is really sad because, you work a lifetime, you put money away, you're actually putting money away for the future. So you're doing away with certain things that you would want to do today, because you want to make certain that you have a secured retirement, and you put money away in your IRAs, your 401ks, your investments, your mutual funds, your stocks, your bonds, and so forth. But very few of you, if any, are paying attention to taxes. And all of a sudden now you get to the promised land, you get to the summit of retirement, which is the day that you decide to retire. And now you're going to be in for a long ride because you didn't do any proper tax planning. You failed at tax planning 101, and that's going to create tremendous havoc for you and your family. And more than likely, you're going to run out of money before you run out of life. And that's something sad, but I see it every day because I have clients coming to see me for the first time. And, they wanted to do one thing in their portfolio, in their retirement portfolio, and they ended up doing something else because they were only paying attention to one small portion of that decision-making process. So now, obviously, many of you know, I wrote a book in 2021 that has been published on Amazon. And if you want to learn more about taxation, about how to prepare for retirement and how to do it the right way, you're welcome to just go to Amazon and pick up my book. It's called Retirement Paradigms, Managing Retirement Risk in the 21st Century. So it's a very risk management approach to retirement success. So you can just pick it up on Amazon. And basically, there I talk about, I'll just give you a few of the pointers here, but primarily, the new world of retirement and the importance of understanding that, managing the major risks in retirement, which very few of the people that I engage for the first time have ever done, tax planning and tax-free retirement. If you want to increase your opportunity for success when it comes to retirement, then why don't you make it a tax-free retirement? Because otherwise, the IRS and the government is going to dictate what percentage of your retirement assets they're going to keep for themselves, how to avoid Social Security pitfalls, how to avoid the fatal four in retirement, and much, much more. So in that portion of the book, I dedicate a tremendous amount of information for all of you to become educated and to become knowledgeable when it comes to retirement planning and retirement distribution planning, which is even more important. Now, you'll see there now what the tax brackets are. And I did this, I didn't do it for single individuals or people that file single. This is primarily for married filing jointly. And you see that there are 7 tax brackets. You have the 10%, the 12%, the 22%, the 24%, the 32%, the 35%, and last but not least, the 37%. There's also an 8th tax bracket, which is not shown there, and that is the 0% tax bracket. And that's a tax bracket that I want to get the vast majority of my clients to once they hit retirement age. So, but I just wanted to give you a flavor of what it does, what it is. Now, remember that the tax system in the United States is a progressive tax system. So as you make more money and you go from one bracket to the next, you're going to be paying a higher tax on those dollars that fall in that individual bracket. So for instance, if you're in the 10% tax bracket, you're going to pay a 10%. But once you hit that $19,901 of taxable income up to $81,050, now you fall in that 12% tax bracket. So any monies that fall between 19,901 and 81,050 will now fall into that 12% tax bracket. And also take a look at once you go from $81,051 to $172,750, now you fall into the 22% tax bracket, and then you'll see you'll go into 24, 32, 35, and 37. Now remember, these are your tax brackets, and it's not the effective rate. Usually the effective rate, it's lower than that because the effective rate takes a look at the average between all of the income that you paid at the different tax brackets. So if you're earning $100,000 in a given year, a percentage of the $100,000 is you're going to pay at a 10% rate, another percentage at the 12%, then another percentage you're going to pay at the 22%, and then when you average and you add all of those and divide them, then you'll get to the effective tax rate, which is the one that we need to pay attention to when it comes to tax planning. But I felt it would be a good opportunity for you to understand that there's 7 brackets that you're going to have to deal with in taxation once you fall into tax liabilities. Now, let's talk a little bit about Social Security benefits and taxes. Always remember that Social Security benefits are taxed based on your other income. As a matter of fact, up until 1983, your Social Security benefits were never taxed. But under the Clinton administration, they voted into law the taxation of Social Security benefits based on your other income. So if you have to pay taxes on your Social Security benefits, think of it as double taxation. Because when you earn the living and you make contributions to Social Security via tax deductions directly from your paycheck, that was a tax liability that you had to pay whether you wanted to or not. So all of a sudden, you're being charged a tax that goes into your Social Security taxation for the year. And then when you get ready to retire and you're going to start pulling that Social Security benefit, then you're going to be taxed on that money again. And most Americans will be taxed on that money again. And that's sad, but that's a world that we're living in. And that's something that you're going to have to deal with because taxation is going to be very critical for you and your family when it comes to your retirement distribution planning once you reach that summit of retirement, as I talked to you earlier. No. So now the next question is, well, what are some of the other income that may have a negative impact on the taxation of my Social Security benefits? And as you see there on the slide in front of you, the way that is worked out is as follows. So if you're married and you're filing jointly, you're going to take the combined Social Security benefits that you're being paid, and then you're going to take 50%, or your accountant or your tax preparer is going to take 50% of the Social Security benefits that you have received. Then on top of that, they're going to be adding your ordinary income. So let's say that you retired, but you continue to work on a part-time basis. That income is going to be added onto the provisional income calculation as well, in order to determine what percentage of your Social Security benefits are going to be taxed in retirement. Let's say that you didn't work part-time, but you opened a business and you started generating some business. Well, that's going to become part of that additional income that is going to have to be taken into consideration. So ordinary income gets added on to 50% of your Social Security benefits. And then you have to add dividends and capital gains. So if you sold a piece of property or you sold a stock and you had a profit in that stock as a capital gain, whether it's short-term or long-term capital gain, you have to add those figures onto the provisional income calculations as well. Once again, to determine what percentage of your Social Security benefits are going to be taxed in retirement. And then last but not least, oh, by the way, in dividends and capital gains, so if you have stocks that are paying you a dividend every single year, or you have bonds that are paying interest every year, those are going to have to be added on to that calculation. And then last but not least is what they call non-taxable interest. So if you have investments in municipal bond funds or municipal funds, although in most cases, any income you generate from municipal bonds and municipal bond funds are federal income tax free to you, but those numbers are going to be added on to the provisional income calculation, and those numbers are also going to help determine what percentage of your Social Security benefits will be taxed in retirement. So, that's something important to understand. Now, remember, I did say to you that the thresholds to determine what percentage of your Social Security benefits had never been indexed. What that means is that more and more Americans every year, because of the fact that people are earning more and more as we go along, more and more Americans are falling into the Social Security torpedo tax, as I call it, because it's a tax that you were not expecting. Unless you're watching this podcast and webinar and video conference, you wouldn't know otherwise. So it's going to catch you by surprise. But you're going to pay dearly for that because you're going to be taxed on that more than likely for the rest of your life. So the fact that those thresholds are not being indexed is actually forcing more and more people to pay taxes on their Social Security benefits from one year to the next. And that's something that the government wants because they want more and more of your money. So here are the rules, just so you'll know. If you want to avoid Social Security taxation, or if you have to pay Social Security taxation. Now, if you're single, if your total income that I just went through, 50% of your Social Security benefits plus the ordinary income in retirement that you generate, dividends and capital gains and interest from municipal bond funds, if all of that is under $25,000 and you're single, you don't have to pay any taxes on your Social Security benefits. Now, you're going to be in poverty, but you're not going to pay taxes on that. But if you're single and your income is between $25,000 and $34,000, 50% of your Social Security benefits will be dragged onto the tax liability table, and you will be taxed on 50% of your Social Security benefits. Anything over $34,000 that you earn in retirement above that Social Security threshold, your 85% of your Social Security benefits will be dragged now onto those tax tables. So either you pay 0% by doing proper tax planning, or you're going to pay either 50% or 85% of those benefits are going to be taxed to you and your family based on whatever tax bracket you find yourself in when you file your taxes at the end of the year. Now, if you're married filing jointly, you have a little bit more of a break, but it's not that much. So if you're married filing jointly and your total income, reportable income under provisional income calculations is less than $32,000, then you pay zero taxes on your Social Security benefits. If it is between $32,000 and $44,000, as you see there, up to 50% of your Social Security benefits will be taxed, and anything over $44,000, up to 85% of your Social Security benefits will be taxed in retirement. So for those of you that want to avoid the taxation of Social Security benefits, you better start doing some planning now, because otherwise you're going to pay dearly and you're going to pay for the rest of your life. Now, what happens in reality from a retirement standpoint if you have to pay taxes on your Social Security benefits? Basically, the guidelines and the calculations that I have done for years will basically state that if you have to pay taxes on your Social Security benefits, you're going to run out of money anywhere between 5 and 8 years sooner than if you didn't have to pay taxes on your Social Security benefits. Now, the question is, well, why is that? Well, simply speaking, if you have to pay taxes on your Social Security benefits, you have to draw money from another retirement source in order to offset that tax liability and or be able to maintain your lifestyle. So if you can avoid taxation altogether, or at least if you can avoid the taxation of your Social Security benefits, then it's going to be good for you from that perspective. And now your assets are going to live longer than otherwise forecasted. So it's important to pay a lot of attention to, how it is that the calculations are being done. And you should do this right before you retire. You don't want to do this. You want to do this, 5 years before retirement. So at least you'll have time to plan an exit strategy from that torpedo tax and or that tax liability for you and your family in retirement. So that's something for you to pay attention to quite dearly. Now, let's talk a little bit about tax planning 101. And what I'm about to say is going to be very surprising for the vast majority of you. And I'm actually going to show you in numbers, because at the end of the day, what you're going to realize is that when it comes to retirement distribution planning, a lot of the stuff that you think you know about retirement, you really don't know whatsoever. And this is something that you got to pay attention to, because in retirement, not all income is created equal. And I'm going to walk you through different income scenarios in the next few minutes so you can really understand the power of doing tax planning at the very highest level that you can possibly do. Because every time you do some tax planning, you're going to keep more of your money and you're going to give less of your money to the IRS and the US government. So let's get into it, because this is going to be very important. And I would appreciate it if all of you are going to pay attention to this. And if you want, you can actually download the video and you can watch it as many times as possible along the way. So let's talk about somebody that reaches retirement and they don't want to take Social Security benefits because they want those benefits to go a little bit longer. So they decide to retire. And they're going to say, you know what, I'm just going to take $50,000 a year. Let's say this is a particular client or retiree that can live on $50,000 a year. And as you can see there, the individual retire with $50,000 of income. Notice that they receive $50,000 of income out of their IRA and or 401k distribution, and they paid a total tax of $2,317, which the effective tax rate is 4.63%. Now, remember, someone in this income bracket, their ordinary tax rate is at the 12% tax rate, but after you pay a portion at the 10%, then a portion at the 12%, and then a portion at the 0%, then the average tax rate in this case would be 4.63. So, you say, well, Bert, if I can take $50,000 out of my IRA and only have to pay, $2,300 and change in taxes and or 4.63% of effective tax rate, that's not too bad. I'll take that every day of the week. And, I would say to you, well, that's not bad at all. But the question is, can you improve the situation? And how far can you improve the situation? Because if you're only taking 50,000, perhaps you need more. You just don't want to take any more because you don't want your tax liability to suddenly increase to a higher level that you feel comfortable with. So I'm going to give you the next exercise because I think it's going to start opening your eyes as to why tax planning is so important. So in this case, let's say that instead of just taking $50,000 out of your IRA or 401k, we're going to do a Social Security benefit and an IRA or 401k distribution combination. So let's say if you're married filing jointly and you and your spouse are generating, let's say, $35,000 out of Social Security benefits, and we're going to take $35,000 of Social Security benefits, and we're going to add another $15,000 of distribution from your IRA and or 401k to arrive at that $50,000 level. Well, take a look as to what just happened if we did it that way. In the first scenario, the green is the one from the previous slide, which is the one that is the benchmark. We're going to measure everything against that 50,000. You ended up paying $2,317 on that 50,000 of IRA 401k alone, and your effective rate was 4.63. But now, by combining Social Security distribution and IRA or 401k distribution as a combo, you're still generating the same $50,000, but now your total tax liability is zero. So you actually pocketed an extra $2,317. That could be a car payment on an annual basis. So you just pocketed $2,300 and you're still receiving the same amount of income. Now, the next question is, well, Bert, if I, felt comfortable just paying that $2,300, that $2,300 off taxes in the first scenario, and I know you just saved me that money because I did that combination of the Social Security benefits and IRA or 401k, and I didn't have to pay anything. But, what if how much more money, instead of just taking the 15,000 out of my IRA or 401k, how much money could I comfortably take out of those retirement accounts without having to pay taxes? So here's a scenario for that. You're still receiving your $35,000 from your Social Security benefits, and you can now take up to $23,000 of additional dollars out of your IRA and your 401k. So now your income is going from $50,000 to $58,000, as you see there on the red. Your tax liability is zero, so you took $8,000 more than what you had taken before, and you pay zero in taxes. So now the additional income that you're receiving is $10,317. So that is the $58,000 that you're not taking tax-free, plus you're also pocketing the $2,317 that you would have paid if you had only taken out $50,000. If you had taken out just $50,000 out of an IRA or 401k income. So now you're taking more money, you're getting more income in your pocket, and you're paying 0% in taxes. So what have you just done? Well, you just created the perfect storm. Think of it this way. Every income that you generate, or every distribution and you get out of IRAs and 401ks, or your pensions, or your SEPs, or whatever profit sharing plan you may have, is going to be taxable in retirement. But because you have done proper tax planning calculations and you did tax planning 101, now you put the money into an IRA and a 401k and you took a tax deduction on that, so you didn't pay any taxes. That money has been growing tax deferred on your behalf and that of your family for many, many years. And now when you're reaching retirement that you're supposed to pay taxes on that, now you're going to be taking money out of those accounts and not pay a single dollar of tax. So now you had pre-tax, you had tax deferred, and tax-free distribution. That's the best of all worlds, but unless you do tax planning 101, you're never going to get to that level. So that is important for you to understand, because otherwise you're going to be giving away free money and you're definitely going to run out of money before you run out of life. So let's take a look at a couple of more scenarios. The next scenario is one where you say, well, Bert, I'm okay paying that $2,317 that I paid in the first scenario. So how much more income could I generate or take out and just be able to pay that same $2,317 that I paid in the first slide that you showed me? Well, in this case scenario, we're going to take $35,000 of Social Security benefits. We're going to add the $23,000 of IRA distribution, so that way you were up to $58,000 and you had no tax liability whatsoever. And by the way, if you have other investments in your portfolios, like long-term capital gains that you can sell, we can take a portion of those capital gains investments and sell them, we can actually add another $28,810. That will bring your income now from $50,000 in the original scenario, in which you paid $2,317 in taxes. Now you're taking out $86,210. So you're taking an additional income of $36,210, and your tax liability is the same $2,317 that you paid when you only took $50,000 out of your IRA and 401k. Isn't that crazy? Now you're using leverage. Now you're telling the IRS, you say, look, I'm not going to allow you to control my retirement distribution life. I'm going to take control of that myself, and I'm going to choose from which assets I'm going to be taking money from in order to maximize my income, my net income, and that of my family, and paying you the least that I possibly can in order to go from point A to point B. So now you have all that additional income for the same amount of tax liability. Let's go to another scenario. And this is a scenario where you're taking $35,000 of Social Security benefits. And let's say you don't have any long-term capital gains. Well, all you have is IRA and 401k distribution. So you can actually add another $35,950 of IRA distributions. So you're now at $70,950. So you have an additional $20,952 of income compared to the first scenario that we're using as the benchmark. And you're still paying the same amount of tax. In this case, it's only a couple of dollars. Difference is $23.15 instead of $23.17. So, but you got $70,950. You got an additional $20,950 for the same amount of tax liability that you would have paid otherwise. And now I am going to blow your mind off. And this is where now you want to make even more money. And you have long-term capital gains, so you have a lot of investments, or you have real estate properties that you can sell, or you have stocks that you can sell, and you're kind of watching because you don't want to sell too much of it because you don't want to increase your tax liability. Well, in this exercise, you have $35,000 of Social Security benefits that are coming to you. And then let's say you have a lot of long-term capital gains that you want to distribute. We can take $91,520 of capital gains to give you an income of $126,520. Let me repeat that again, guys and gals. Now you're taking $126,520 in income compared to the $50,000 in the first slide, which is the benchmark, and you're still paying $2,316 in tax liability to the IRS. Isn't that crazy? You see how important tax planning is from a business perspective, how you can start to really use different scenarios in order to maximize your income so you can live at a higher standard of living while minimizing your tax liability. The challenge is that the vast majority of you and the vast majority of Americans are never going to be able to do this because you haven't planned for it. You think you know it all, and you don't. When it comes to tax planning, you know, you're either at the table or you're on the menu. So it's up to you. Do you want to be on the menu so the IRS can come and eat you away? Or do you want to be at the table and dictate how you're going to be paying your taxes in retirement? Now, if you have time, you can also do a number of things because there are certain vehicles that are excluded, not only from Social Security taxation or the calculations for provisional income, but they're also excluded from tax liability. And there are three products that will allow you to do that, or three investment tools or 3 investment vehicles: your Roth IRAs, your Roth 401ks, and your 7702 plans, which are cash value life insurance plans. And those I call the rich man's Roth IRA, because if you do it properly, you can start putting a lot of money into those plans, and you can maximize your tax benefits, reduce your tax liability completely, and by the same token, have total control of your retirement assets. Because remember, most of you have been planning for retirement accumulation. Very few of you have done any type of planning about retirement distribution. And this is what I have just covered for you. And this is, by the way, this is just a mere speck of the things that I have the capability of doing for you and your family when it comes to your retirement distribution planning. So for those of you that may want to schedule an appointment with me, and you can call me, we can talk about your specific situation. I charge a fee for that service if you agree to it. But believe me, my fee is going to be minimal to the amount of benefit that you're going to receive, because once we do this, you can do it every single year for the rest of your life. To get us, you can see there on the screen, you can send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And you can also reach out to me via telephone at area code 305-304-4770. Always remember that my goal when I do all of these video conferences and videos for you, and podcasts and webinars and seminars, is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So once again, my friends, let me go ahead and take you off sharing the screen at this point. So once again, I want to make certain that all of you have been able to understand this. If you want to watch it once or twice again, do so, but you must do something. Most accountants that you meet with are not going to be very good at figuring out provisional income calculations, but this is a specialty that I have here at Gables Tax Planning Group. So for those of you, I want to wish you all that are watching this, I want to wish you all a wonderful holiday season. Please reach out to me if you have any questions, and I'll talk to you soon. Take care. Bye-bye.